Compounding is a lie. Not the math. The math is perfect. The lie is what they tell you about the math. They say, just invest consistently and wait. And that's true. But here's what they leave out. The wait is miserable. For years, sometimes close to a decade, your portfolio barely moves. You do everything right. You invest every single month. You don't panic. You don't touch it. And your account looks like it's broken. And then something shifts. The numbers stop adding. They start multiplying. And the wealth you couldn't build in 9 years, you build it again in 6, then again in 3. That's not motivation. That's not a pep talk. That's the mechanical reality of how compound interest works over time. And there's a specific framework that maps it out, phase by phase. It's called the 9-6-3 rule. And by the end of this video, you'll understand exactly why the explosion is inevitable if you don't quit first. Let me introduce you to someone. We'll call him Marcus. He's 30 years old. He started investing $300 a month 2 years ago. He's in index funds. He's diversified. He's been consistent. He checks his account today. He has about $8,500. His contribution total? Just over $7,200. So his 2 years of discipline, every month, no excuses, returned him barely over $1,000. He could earn that in a week of overtime. And here's the question Marcus is asking right now. Is this even worth it? This is the most dangerous moment in any investor's journey. And it's not because Marcus is wrong about the numbers. He's not. The numbers are telling the truth. Compounding at the beginning is slow. It's painfully, demoralizingly slow. The true power of compounding lies in its ability to accelerate over time. While in the early stages the growth might seem almost invisible, as the years pass, the rate of growth becomes dramatically more significant. The problem is that most people judge compounding by what it delivers in years 1 through 3. That's like judging a rocket ship by how fast it moves on the launch pad. If you invest $200 per month at an average 8% annual return, after 10 years, you'd have around $36,000, even though you only contributed $24,000. Keep that same plan going for 30 years, and your balance could exceed $280,000. But here's what nobody draws on a chart: how that growth is distributed across time, because it's not even close. And the 9-6-3 rule is the framework that finally explains why. The 9-6-3 rule breaks a standard 18-year investing timeline into 3 distinct phases, and the math behind each phase will completely change the way you look at your portfolio. Here's the framework at its simplest. Phase 1, the foundation phase, 9 years. Phase 2, the acceleration phase, 6 years. Phase 3, the explosion phase, 3 years. Total timeline, 18 years. But the wealth built across those 3 phases? Almost nothing. Then a little. Then everything. Let me run the actual numbers so this stops being abstract. Imagine you invest $400 a month into a diversified index fund portfolio. The S&P 500 has averaged around 10% annually over the last 30 years. To be conservative, we'll use 8% throughout this example. Phase 1, years 1 through 9, the foundation phase. At the end of year 9, your portfolio sits at approximately $67,000. You've contributed roughly $43,200, so compounding added about $24,000 on top of your contributions. Progress? Yes. Life-changing? Absolutely not. You're building the base, the raw material the engine needs. This phase feels like almost nothing is happening. That's by design. This is where most investors either celebrate too early or give up too soon. Phase 2, years 10 through 15, the acceleration phase. Here's where things start changing. At year 15, that same portfolio, same monthly contribution, same 8% return, has grown to approximately $139,000. You've added another $28,800 in contributions, but compounding added over $43,000 on top. That's almost double what it added during the entire first phase. The engine is no longer warming up, it's running. Phase 3, years 16 through 18, the explosion phase. Now we're in the territory most investors never see, because they quit before getting here. By year 18, your portfolio crosses $190,000. In just those final 3 years, your wealth grew by over $50,000. That's more than it grew in the entire first 7 years combined. 3 years. More wealth than the first 7. That is the 963 rule. The snowball doesn't move much on flat ground, but the moment it hits the slope, it accelerates faster than you believe is possible. Let's make the acceleration of Phase 2 and Phase 3 even more concrete. There's a simple mathematical concept that explains exactly why compounding explodes in later years. It's called the Rule of 72. At a consistent 7% interest rate, an investment can double in value roughly every 10 years. You simply divide 72 by the annual interest rate to get the approximate number of years needed for doubling. At 8% returns, your money doubles roughly every 9 years. Here's why that changes everything. In Phase 1, you're doubling a small number. If you have $30,000 at year 4 or 5, doubling it gets you to $60,000. Meaningful, but still relatively modest. But when Phase 3 hits? At a 7.2% compounding rate, $50,000 would double 3 times, reaching $400,000 over a 30-year frame. Given another decade, it doubles once more to $800,000. That's the mechanical reality. The percentage return never changes. What changes is the base it's applied to. In Phase 1, your base is small. In Phase 3, your base is enormous. Same percentage. Completely different dollar amounts. The explosion isn't special. It's not luck. It's the inevitable result of a large enough base meeting a consistent rate of return. Every single time. Now here's the part that should make you angry. Most investors don't make it to Phase 2. They quit right at the end of Phase 1, around year 7 or 8. Not because the system failed them. Because the system looks like it's failing them right before it's about to work. Think about what year 8 feels like. You've been investing for 8 years. You've been disciplined. You've ignored the noise, stayed out of meme stocks, maxed your contributions, and your portfolio still looks like a flat line compared to what you were promised. The frustration is real, and the data says it's almost universal. Despite another roaring bull market in recent years, average equity investors were tripped up by their own bad behavior, underperforming the S&P 500 by nearly 850 basis points. Whether through late re-entries, poor rebalancing, or tactical moves that missed rallies, more effort, less return. And it gets worse. Over a 20-year period, the average U.S. equity investor returned 9.24% per year compared to the S&P 500's 10.35%. That gap seems small. Barely 1%, but over 20 years on a growing portfolio? The same $100,000, if left untouched in the S&P, would have grown to $717,000. The average investor, whipsawed by poor decisions, finished with just $345,000, costing himself more than half due to self-inflicted wounds. The enemy of the 963 rule isn't bad market conditions. It isn't inflation. It's the investor's own behavior, and specifically, the moment they decide to quit right before Phase 2 begins. Imagine quitting a race at mile 8 of a 9-mile course. That's what quitting at year 8 is. So why do people quit at year 8? Because 3 specific emotional forces arrive right on schedule, designed to push you out of the game. Threat number 1, the comparison trap. Years 1 through 4. In the early years of Phase 1, someone in your orbit is making noise about fast money. Crypto, a hot stock, a friend who doubled their money in 6 months. And you look at your modest portfolio crawling upward and ask, why am I doing this the slow way? Research documents this pattern clearly. Loss aversion, anchoring to past experiences, overreacting to news, copying others. Each contributes to panic selling, late buying, and constant second-guessing. Actions guaranteed to drag down returns. This is the phase where people change strategies. They jump into something exciting. They reset the clock on their compounding, and they start Phase 1 all over again from zero. Threat number 2, the plateau frustration. Years 5 through 8. By mid-Phase 1, you've put in real money, thousands of dollars, and the returns still feel linear, almost insulting. This is where the doubt stops being whispers and starts feeling logical. Maybe I'd be better off in real estate. Maybe I should wait for a dip. Maybe I should cash out and start fresh. This is the most dangerous phase psychologically because the frustration is valid. The growth really is slow here. But it's slow because you're building the base that Phase 2 and Phase 3 run on. Quitting in the frustration phase is like pulling a plant out of the ground right before it blooms. Threat number 3, the crash panic. Can happen in any phase, markets crash. That's not a possibility, it's a certainty. At the trough of the 2020 crash in March of that year, the S&P 500 had fallen 34% from its February peak. And during the 2007 to 2009 bear market, the index lost approximately 50% of its value. When your account balance drops below what you contributed, every instinct tells you to get out. But history is brutally clear about what happens to people who listen to that instinct. The S&P 500 bounced back to its previous highs by November of 2020, 8 months later, with a 15.6% gain for the year. And 1 year after each of the S&P 500's 10 worst single-day drops, the index posted double-digit positive returns in all but one instance, and remained positive 3 and 5 years later too. The people who panic and sell lock in their losses. The people who hold, or better yet, keep buying, capture the entire recovery. The crash is not the end of compounding. It's a stress test. And the 9-6-3 rule is what keeps you grounded enough to pass it. Let's go back to Marcus. Remember, he's 30, he's frustrated, he has $8,500 after 2 years. He nearly quits, but instead, he learns the 9-6-3 rule. He understands that he's barely into Phase 1. He understands the base he's building right now is why Phase 3 will be extraordinary. So he commits to the full 18-year arc, and he bumps his contribution slightly as his income grows. Here's what Marcus's story looks like. Year 9, age 39. Portfolio sits at $67,000. Still feels slow, still looks modest. But the base is built. Year 15, age 45. Portfolio reaches $139,000. The acceleration is now visible. Something has shifted. Year 18, age 48. Portfolio crosses $190,000. In the last 3 years alone, he added over $50,000 in wealth, more than the entire first 7 years combined. And Marcus didn't do anything spectacular. He didn't pick a 10-bagger stock. He didn't time the market. He just refused to quit at year 8. Now compare Marcus to his friend David. Same age, same income, same $300 a month. But David pulls out at year 8 after a market dip spooked him. He waits 18 months before reinvesting. He misses a significant chunk of the recovery. He restarts Phase 1 halfway through. A $10,000 investment earning 7% annually grows to approximately $76,000 in 30 years. Waiting just 5 years to invest reduces the ending balance to $53,000, a difference of over $22,000. Gaps cost compounding its fuel. Time. Every month Marcus stayed in the game while David sat on the sidelines is a month of Phase 3 David will never get back. The 9-6-3 rule isn't just a mental model, it's an operational framework. Here's how you put it to work. Step 1. Know what phase you're in. Open your investment account right now. Count the months since your first contribution. If you're in years 1 through 9, you are in Phase 1. This is the grind phase. The numbers will be slow. That is not a malfunction. That is the foundation being laid. If you're in years 10 through 15, you're in Phase 2. This is where you should already feel the shift. Contributions still matter, but the compounding engine is now contributing alongside you. If you're in years 16 through 18, stay there. Don't touch it. You are in the explosion phase. Step 2. Automate everything and check quarterly at most. Investors who attempt to time the market guess the direction correctly only about 25% of the time. 1 in 4. You are not good at timing the market. Nobody is. The solution is to remove the decision entirely. Automate your monthly contributions so they happen whether you feel good about the market or not. Step 3. Increase contributions as income grows. Poor market timing has cost investors over 1% per year in recent years, and the antidote isn't perfecting your timing. It's consistency and growth. When you get a raise, route a portion of it to your investment account. You won't miss what you never had. Step 4. Have a written crash plan. Before the next market drop happens, and it will, write down what you'll do. Write, I will not sell. I will continue my automatic contributions. I will look at historical recovery data. then sign it. Because when panic arrives, your future self won't have the clarity your present self does. During any time period since 1950, you could have closed your eyes for a decade and reopened them to find the S&P 500 at a higher price. That's not optimism. That's the historical record. Let it be your anchor. Everything about the 963 rule is backed by documented, repeatable, multi-decade data. The historical average yearly return of the S&P 500 is approximately 9.4% over the last 150 years, across wars, crashes, depressions, pandemics, and inflation cycles. The engine doesn't need perfect conditions. It needs time. The S&P 500's 20-year average return through the end of 2025, a stretch that includes the 2007 housing crisis and the worst recession since the Great Depression, was 11%. Even with the worst financial crisis in a generation embedded in the timeline, a 20-year investor averaged 11%. The 963 rule doesn't ask you to believe the market will always go up tomorrow. It asks you to accept that over 18 years, across every historical period on record, the math has worked. Every single time. Compounding doesn't feel slow because it's broken. It feels slow because you're watching it in the wrong time unit. You're checking monthly. Compounding works in decades. You're frustrated by year 3. Compounding rewards year 15. You're comparing your phase 1 to someone else's phase 3 and calling yourself a failure. The 963 rule gives you the one thing most investors never have: context. Phase 1 isn't slow. Phase 1 is necessary. Phase 2 isn't a reward. Phase 2 is the engine catching. Phase 3 isn't luck. Phase 3 is the inevitable result of phases 1 and 2. The only variable, the only one, is whether you stay. Over time, the compounding effect accelerates, allowing your investment to grow exponentially. The key factor here is time. The longer you leave your money to compound, the more substantial the growth becomes. That's not a tagline, that's a mathematical law. Marcus, the frustrated investor from the start of this video, he only needs to do one thing: stay. The explosion is already built into his timeline. He just has to not quit before it arrives. Don't quit at year 8. Phase 3 is waiting. If you like this video, like and subscribe. However, I'm not a financial advisor. This video is for educational purposes only. Always consult a qualified professional before making investment decisions.